So the question is, if your company's EVA is negative and you want to sell this company to somebody so as to get rid of it, the question that arises is why will someone buy your company when its EVA is negative? And remember, someone will buy your company is because that someone has a better synergy with your company together with his company. So, in one way or the other, with the combined entity, there will be a lot of areas of synergy. As a result of that, either the revenues will increase or the costs will go down or both will happen. That is on the operational front. On the financial front, it is possible that someone who is acquiring your company, who is willing to acquire your company, that someone has got access to the funds which is cheaper than what you have. So, therefore, that somebody who is acquiring your company, and please remember, anyone anyone should acquire or will acquire another company only when he has got two distinct advantages. On the operational front, he should be able to increase the revenue from the combined entity, which is 1 plus 1 should be 11, and number two, he should be also able to bring the costs down. So if he is able to bring the cost down on one hand, and if he is able to increase the revenue, what is going to happen is he is going to generate a better bottom line. And since the bottom line is better, and therefore as a result he would be able to see an impact in the return on capital employed. So he would be able to increase the return on capital employed because of the synergies that he is having with these operations combined with his operations. And number two, it is also possible that this someone who is buying your company has an advantage of access to cheaper funds. Since he has an advantage or benefit or facility available with him where he is able to access cheaper funds, what he would on the other hand achieve is lower cost of capital employed. So what is going to happen is, on number one, he is going to increase the return on capital employed, and number two, he is also able to achieve lower cost of capital. On one hand, the ROCE is going up, on the other hand COCE is going down, and the combined impact is going to be double whammy as far as the EVA is concerned. And that means what? That means economic value added of this company is going to increase sizably, and that will reflect in the market price of this company's combined entity share going up. That will again reflect in terms of even cheaper funds being made available to this entity. And this is how somebody would be willing to buy your company whose EVA is negative.